It can feel like every swing in the financial markets these days is tied to headlines coming out of Europe. Jamie Cox of Harris Financial Group says there are some moves you can make, starting with picking up some dividend-paying stocks other than utilities. Jamie joins us this morning from Richmond, Virginia. And Jamie, taking a look at the returns so far this quarter, why not utilities or other defensive sectors? Utilities are up about 1%. The other defensives have fallen less than the cyclicals. Why not pick up those stocks? Because they do pay dividends and they are performing better.
Well, Scarlet, I think utilities still represent a good opportunity, but I'm saying on a relative basis, they've kind of held up like you suggested. Therefore, they're a little bit more expensive than some of the oils or technology or some other things where you can actually pick up a little bit different or actually larger dividend yield than you can in the utility space. I still like utilities. I think they're fine. But if I'm a buyer today, I think that you can find better value because the prices of other things have dropped in relation to utilities. You're exactly right. But I think energy represents a little bit better opportunity to pick up substantially similar yield while oil prices and other commodity prices have dropped dramatically over the last month.
Right. So the entry point for energy or technology might be better right now. What are some of the other investing themes for the fourth quarter after this pretty disastrous third quarter for anyone in stocks?
Well, I think it's important for investors not to chase yield. For example, if you were to look at European banks, you would notice that dividend yields on those particular investments are really, really high, 8, 9, 10%. But that's dangerous territory because if bank capital continues to deteriorate, those yields are going to be, those dividends are going to be cut. And you don't want to be in that trap where you think that buying yield or buying that dividend is actually safe, because it isn't. Mm-hmm. You have to have an underlying ability for the company to maintain that dividend with underlying sales. So that's why I like technology, because I think the technology companies actually can support the yields that they're in the marketplace today. For example, Cisco, I think, is at a level where it can support that yield. It's got plenty of cash. And the sales, although not robust, are sufficient to cover the capital cost of those dividends. So I think that's what you have to concentrate on. You have to take that long view,
sure.
And if you do, you'll benefit from it long term.
Well, that brings me to my next point, which is a lot of investors are reluctant to put money to work on fears that earnings will slow down later this year into next year. Yet you see companies very buyback happy, willing to put their cash into repurchasing their own shares. That would seem to signal then this reluctance on investors' part that companies are wrong perhaps in believing that their stock is undervalued, or at least their timing's a bit off.
Well, Scarlet, one thing you have to remember too: sometimes companies will buy back stocks trying to put a floor under what they think the price will go down to. I think that may be the case in the case of Berkshire Hathaway. Warren Buffett isn't buying his stock because he thinks it's overvalued. He's buying it because he wants to be able to get it lower. So I think you have to be careful when you're talking about buybacks. Dividends are a different animal. When you return capital to shareholders, that actually goes outside, and it doesn't. There's no benefit really to the company to pay dividends other than to attract investors. So I actually like the dividend player a lot better than the stock buybacks. I think that's a much better thing, particularly when you're trying to take a relative play versus treasuries, where you got a 30-year yield or a 10-year yield that's really low. Having increased dividend policy actually makes your company's stock more attractive relative to those treasuries. So I think that's a better play for most companies. Okay,
so seek those dividend-paying stocks as opposed to those companies buying back their shares.
Right.
Jamie, normally at this time of the year, we'd be talking about an end-of-the-year rally, a pickup in the fourth quarter. Instead, we've got a slew of economic data from around the world that suggests a slowdown is coming. Is a global recession at this point inevitable?
I don't think it's inevitable, but it's certainly being priced in. I mean, you never really know whether it's going to be a recession until it's actually over. The data suggests in the United States that we're nearing recession, but we're not quite there yet. I mean, there are many factors that could point to we have been in a recession if you use the right deflators. But I actually think we're going to be picking up in the United States. I'm not so certain about Europe. I think Europe is probably, if we were to have to make a bet about which one's going to go into recession, the European economy would be the first that I would pick. Mm-hmm. And in Asia, I think a slowdown. Who knows what recession means in Asia when you talk about, China with 7% GDP growth. That looks like a recession, but it's technically not. So I'm not really sure that I would draw any conclusions from the data that currently are being produced. I think it's going to be a wait and see.
Well, you mentioned Europe and how it might be the first to tip into recession. What we saw this morning was a surprise pickup in inflation, along with fears that growth will slow. That suggests stagflation, right?
Yeah, it's a classic case, and that's a really difficult place to be. There's been a lot of rumor circulating that the ECB is going to cut rates, but when you have that stagflation environment, it makes it very difficult for a European central bank with a single mandate to cut rates in the face of rising prices. So I don't think that's going to be the saving grace that a lot of people have been hoping for. Bailouts aren't the answer. These government stimulus programs do nothing except just extend the pain. So if we don't get it done quickly and let the free market work, we're just going to be dealing with these things quarter after quarter, and it's just going to get worse and worse.
Yeah, it's just the beginning of more to come. Thank you so much, Jamie Cox, joining us from Richmond, Virginia.